When planning with some of our crediting executives, we often run into the situation where we need to look at how best to anticipate and manage the impact of receiving a deferred compensation payout. Today we'll highlight a few strategies that help minimize the tax impact of these arrangements. Before we dive in, please hit the like and subscribe button so you don't miss another great personal financial content. Now let's dig in. First off, what are non-qualified deferred compensation plans? Well, a non-qualified deferred compensation plan, NQDC for short, are an excellent way for executives to defer some of their salary and bonuses into retirement, deferring the tax liability until they receive the payout. However, as the executive approaches retirement or key payout dates, it's essential to understand how to manage the tax impact of the payout. The first solution is to spread out the payout. Now, one way to manage the tax impact of this type of payout is to spread it out over several years. The IRS allows for this option, which is called elective deferral. The executive can choose to receive their payout in one lump sum, or they can elect to receive it in equal payments over a set number of years. Now, this option helps spread out the tax liability over several years, which can lower the impact of the payout on their tax bill. A second idea is to coordinate payouts. An executive may have multiple non-qualified deferred compensation plans with different payout schedules. It's important to coordinate these payouts to minimize the tax impact. For example, suppose an executive has two NQDC plans, one paying out in the same year they receive a large bonus, and the other paying out a few years from that. In that case, it may make sense to delay the first payout to the same year as the second payout to lower the overall tax impact. Another strategy is through managing investments. Many NQDC plans allow the executives to choose how their deferred income is invested. Choosing a mix of stocks, bonds, and other investments can help reduce the overall tax impact of the payout. For example, suppose the investments are in stocks that have appreciated over the years. In that case, the executive may want to sell some of those stocks before the payout, realizing a lower capital gain tax rate. Conversely, if the investments are in bonds, the executive may want to defer the payout to take advantage of lower interest rates. Sometimes these plans use life insurance, which is a tax-deferred vehicle that, depending on the arrangement, will altogether have different tax implications. We'll leave these specific situations for a different time. Another good rule of thumb when it comes to managing the tax impact of an NQDC plan is that it's crucial to understand the various tax rates involved. For example, the executive will likely pay federal and state income taxes on the payout, as well as Social Security and Medicare taxes. Understanding these rates and how they apply to the payout can help the executive plan better for the tax impact. Lastly, I want to mention considering charitable giving. Another way to manage the tax impact of this NQDC payout is to donate some of the payout to charity. Now, charitable donations are tax deductible, and the executive may be able to lower their overall tax bill by making a charitable donation. It just depends on the individual's tax situation. In addition, some charities offer charitable gift annuities, which can provide a lifetime income stream while also reducing the tax impact of the NQDC payout. You'll want to carefully work with a financial planner, accountant, and other professionals in a coordinated approach to make the most of these strategies. Managing the tax impact of an NQDC payout requires careful planning and understanding of the various tax rates and investment options. Spreading out the payout, coordinating payouts, managing investments, understanding tax rates, and considering charitable giving are all excellent ways to lower the overall tax impact of this type of payout. With careful planning, executives can maximize the benefits of their NQDC plans and minimize the tax impact on their retirement income. Thank you for joining us today. If you found this insightful, please share with a colleague you care about. And as always, keep doing life better, and we'll see you next time.